Hi, this is Kim Butler. Have you ever had a client say that life insurance has a terrible rate of return? I know I have. And when you can't answer this question succinctly, it costs you enormously in both time and credibility with your clients. So, Todd, if you would take us through a quick demo of what I happen to know is one of your favorite calculators called
It is.
Funding.
Yeah, it is one of my favorites, Kim. Thank you, because of exactly what you said. Most people just really don't understand how life insurance policy works. And for various reasons, the word on the street is that life insurance does have a terrible rate of return. So, with this calculator, something to keep in mind. We're not going to go into how we got the numbers in here. We use the life insurance values tool. So be sure that you have looked at the life insurance values tool tutorial and understand how to use that. That's a critical piece to make this calculator work. It's a place that you can store all the life insurance values directly from the life insurance illustration that then we can simply pull in here, because I don't want to go through that process in front of the client. I want to use the numbers in the calculator when I can explain them quickly with the client. And so just understand that we've already placed those numbers in the life insurance values tool so that we can simply pull them over when we open this calculator in front of the client. All right, so we have an example of a 35-year-old. So we'll put a 35-year-old and we'll project them out to, say, age 70. I always like to go further than my level term insurance, and we'll talk about why that is in a minute. And once that information is in here, I can simply click on the load stored life insurance data. And it's because I've already loaded these different policies into the life insurance values tool. So we're going to pull out this first one, which is an L99 on a 35-year-old. And what we see is a $20,000 premium that has an $843,000 initial death benefit. That's growing over this time frame to $2.4 million in death benefit and $1.4 million in cash value. And Kim, if you would scroll down on this policy, because this one was run as a short pay from the standpoint of we did an offset with this policy and offset it at age 66. So this wasn't a reduced pay policy, but actually just one that we engineered by using dividends to offset the premiums. All right, so here we see in the lower left an internal rate of return of 3.88%. And that's in this current low dividend rate environment because we're in a low interest rate environment. And when we look at 3.88%, it may not look all that exciting, and especially to the client because they're thinking bigger numbers because of the stock market or other things. But what we need to get the client to understand is, wait a second, what kind of asset is this? This is safe, liquid dollars. There's not a lot of things that fit in that same class. I mean, really, you're limited in safe and liquid to savings accounts, checking accounts, money market accounts, CDs. They're semi-liquid, I guess. So when you think about those different things, 3.88% is a terrific rate of return. And I would say that if you pushed past this without explaining those pieces, I think your client's not gonna stay with you. They're not gonna understand what's going on here. So this needs to be understood as a terrific rate of return. And then we're going to take this a little bit further. If we understand that the comparison is to savings accounts, checking accounts, money markets, all of those types of accounts require annual taxes to be paid on the earnings, which doesn't have to happen on a life insurance policy. So let's go up here to our income tax on earnings. We're going to turn that on, and we're going to turn an income tax bracket of, let's just use 24%. And now we see that the language has changed down on the lower left. It no longer says internal rate of return. Instead, what it says is the interest rate on an alternate account to match the PLI. So what it's suggesting is that if we chose not to put money in the life insurance and we put the same $20,000 a year into an alternate account out to age 65 and then stopped and let it continue to grow, that we would have to earn 5.11% every single year on that account so that it could pay its annual taxes and still end up with the same $1,461,994 that our illustration shows is possible with our life insurance policy. So that's quite a bit of an account. That's quite a bit of earnings every year, especially on, again, a liquid savings vehicle that is safe. So if we take that a little bit further and think about what do we get with that life insurance? Is it just the cash value? No, that $20,000 a year buys two things. It buys that growing cash value, and it also pays for the death benefit that exists that would pay out in the unlikely event of a premature death, right? So if we chose to put the $20,000 somewhere else and we wanted to provide the same protection, then what we would have to do is buy term insurance to handle that protection. And so if we include term insurance here, and actually before we do, let's go ahead, well, either way, we can go back up to the load stored life insurance data, and let's put in this 30-year term policy on a 35-year-old, again, that we've already preloaded. And what we see is if we scroll down, actually we don't have to scroll down, you already did. We see $1,231 premium, and what Kim just did was turn that rate of return off because it's overstated. So where our cursor turns into a hand, you can toggle that rate of return on or off. And the reason she's turned it off is we can see that this is what's going to happen to our term premium. It's going to be level of $1,231 a year out for 30 years. And then at age 65, it's going to jump to $50,209. Well, clearly the individual is going to cancel the term insurance at that point in time because the $50,000 is going to be way too much to spend on the term insurance. So what we need to do is change the age to cancel the term insurance to age 64. When we do that, you'll see it draws a line through that because that benefit is now gone. And now she can turn back on the rate of return. And what we see is we'd have to earn now 5.47% every single year to be able to buy the term insurance, pay the taxes, and end up with the same $1,461,000 that our life insurance cash value would grow to over this time frame. Now, that's a pretty substantial rate of return for a safe liquid asset. This doesn't talk about the fact that we've got this cash and we have the ability to use it along the way to create assets even bigger than what we have here. But we can clearly see that this idea that a life insurance policy has a terrible rate of return is absolutely not true. And that's in light of really one of the lowest dividend periods we've ever seen.
Todd, your question is always a good one when clients do say that. Daniel Pink has written in his book, To Sell is Human, to ask the question, compared to what? Because a lot of times clients are comparing the cash value growth of life insurance to a stock account or some real estate deal or whatever it is. They're not comparing it to cash. And so helping them get clear on what is truly an apples to apples comparison by asking the question, compared to what, is a helpful tool. So thanks for joining us for this quick demo. There's quite a bit more that you can do with the funding calculator. And you can read aspects of that on the blog that is on the truthconcepts.com website. Go to the blog section, and on the top right is a search button. You can put in the words funding or anything else that you're curious about and read to your heart's content. Until next time, thanks for joining us.